Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance-related questions that I've received from clients, from email subscribers on the daily email list. Questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribble down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at therogueagent.com. Also, keep in mind that nothing in this podcast is or should be construed as financial, investment, legal, or tax advice. In fact, nothing that I say in this podcast should be construed even as insurance advice, as I don't give individual advice blanket just across the internet unqualified to random strangers. So if you need any of that stuff, contact a licensed professional that you know, like, and trust, preferably someone licensed in your jurisdiction. And now for this week's question. What's the difference between a chronic illness rider and an LTC rider? Oh, great question. Well, there's a big difference. Huge, as they say, at least legally. In practice, they function very similarly, but there's a huge regulatory difference, and you kind of have to be careful when you're advertising, and carriers are advertising these products and these riders. You have to be very careful about like what they say about it and how they say about it. Chronic illness in the insurance business means a permanent disabling condition that you are not expected to recover from. That's broadly. Now, sometimes there's terms and conditions that, kind of modify that definition a little bit. Chronic illness riders are there to protect you from basically permanent disabling conditions. And it could be, or something that's considered to be permanently disabling. It could be like having a stroke or a heart attack or something like that, or dementia or Alzheimer's that requires long-term care, right? So LTC riders, long-term care riders, on the other hand, are intended to pay for long-term care needs, like if you have to go into a nursing home, right? Or pay whenever you qualify, like if you got in a car accident and you couldn't take care of yourself, like you were in a really bad car accident or something, then you couldn't take care of yourself. But basically to pay whenever you qualify for, any other benefits under the rider, which would include some, sometimes temporarily disabling events. So you could go on claim and off claim and back on again, as long as you meet the criteria for the benefit payments. Usually with a chronic illness rider, it's one and done. Once you go on claim, or quote unquote on, because it's not really a claim, but once you go on claim, it's it, right? The rider's triggered and the death benefit is advanced to you. Now, some riders do have modifications, like you can activate the rider, you can stop it, and you can reactivate it again. It doesn't necessarily have to be a permanently disabling condition. Some riders allow you to repay the chronic illness rider back. Some of them don't. Just depends on the rider, depends on the company. But that's generally how they work. So another difference is the chronic illness rider is treated like an advance against the death benefit. Usually it's a lien. Sometimes it functions differently. Like there's some carriers that I know of that they don't do it that way. They use it as, there's an actual cash withdrawal of the face amount. So it is an actual advance. Others, it's more like a lien, where it's like a lien or loan against the death benefit portion. And with an LTC rider, there's a benefit pool. There's like a dedicated benefit pool. You draw from that. It's treated as a cash withdrawal. Benefit pools can also be increased over time sometimes, depending on how the rider works. They can be adjusted for inflation. LTC riders might also contain other special benefits, features that are not found on chronic illness riders. So it really depends. So there's some leeway on LTC riders. if you like some of the, if you kind of go off into the weeds, there might be some benefit that you could get there that maybe you could not get on a chronic illness benefit. The other major difference is cost. So chronic illness riders are typically free at issue, right? So with a small charge, and they'll have like a small charge when the rider is triggered. LTC riders cost money. They cost a lot of money. Not as much as a standalone LTC policy, usually. Sometimes more, but it's pretty expensive, right? And you have to be underwritten for that LTC rider. Whereas chronic illness riders usually they're not going to be medically underwritten like an LTC rider would. So insurance companies do have certain requirements for including the chronic illness rider, but there's no separate underwriting for it like an LTC rider. Usually not. See, usually every carrier is going to have a little process or whatever, but usually that's how it is. One's not necessarily better than the other. They do offer slightly different benefits. If you kind of zoomed out a little bit and kind of looked at it big picture wise, they offer very similar benefits, very similar. Most people, you're not going to be able to tell the difference between in the practical sense. You're not going to be able to tell the difference of what you're getting out of the policy. There's some crossover, right? Some chronic illness riders look very close, very, very much like an LTC rider. They have the benefit pool. They do cash withdrawals, no liens. They look and feel just like an LTC rider, but they're not. And they'll come with a charge, and they'll charge money for it and stuff. So it just depends. It really depends on how the policy is structured, how the rider is put together, and so on. What I have personally seen, and now this probably does not hold true universally, but what I have personally seen in all policies that I've sold is that usually what happens is the chronic illness benefit a lot of times works out to be more money than the LTC benefit. And it's usually with a caveat. It's a lot of times it's the chronic illness rider is going to be based off of non-guaranteed future projected values of the death benefit. And those can change. Those can change over time. You might add a really big death benefit, a really small death benefit. But if the chronic illness rider is based off the non-guaranteed future death benefit, that would be theoretically your future risk of how much of a benefit you get in the future. But if your death benefit grows, and this is why I like whole life insurance, it's pretty stable, fairly predictable in terms of growth. Over time, if you get those death benefits and they grow really big, your chronic illness rider should give you a lot of money if you ever need it, like a lot of money. And some of them, they'll let you advance up to 80% of the death benefit. That's huge. So if you got $1 million policy, theoretically, your chronic illness rider is huge. And to buy the LTC rider at the same dollar amount will cost you a lot of money. The benefit of the LTC rider is that you're not relying on future values. You're buying the pool now. You know what it is. A lot of times it's a guaranteed benefit. You can add to it if you want to. Sometimes you can add to it if you want to. Not always, but sometimes they have it. You'll pay for it. If you put an inflation adjuster on those, you're gonna pay a lot for them. But you know kind of what the benefit is up front. So, it just depends. A lot of people don't want to pay the extra money because here's the thing. If you put a bunch of money into especially if it's like a dedicated long-term care policy, and for whatever reason you don't use it, that money is gone. With an LTC rider, you do kind of get it back, right? Because the death benefit, when you die, the LTC pool gets converted to a death benefit, that gets paid back. Now, the LTC pools on the LTC riders, because it's an LTC pool, takes away from the cash surrender value of the policy. And that's the thing that a lot of people don't like. They don't want to give up the cash surrender value of the policy just to get a potential hypothetical future LTC benefit, right? So again, if you don't need it, you probably would have preferred to have the cash value. With a chronic illness rider, you don't give up any of the cash value. It's just kind of tacked on there. You get it if you need it. It's not there. It doesn't get in your way. If you don't need it, it's death benefit, right? So that is something I think personally what I've seen clients gravitate towards that because of that fact. You're not trading off anything other than, maybe hypothetically you don't have as much in the future and for your chronic illness if the death benefit for whatever reason just doesn't grow. I'm personally not that worried about it, but if you are, then that would be a reason why you might go in the other direction. Anyway, that's the difference between those two riders. Great question. I hope that helps somebody. And I will see you in the next one.
Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to therogueagent.com and sign up for my daily email list.